In the last video, I explained the discounted cash flow model and why it is preferred to the discounted dividend model. In this video, I'll discuss some of the problems with the discounted cash flow model and address how accrual accounting information can be used to overcome some of these problems. When we meet for class on Saturday, May 5th, we'll discuss accrual accounting and valuation, which corresponds to Chapter 5 of the textbook. Let's start by discussing some of the issues that arise from valuing firms using free cash flows, as is done in the discounted cash flow model. First issue that we're going to face is, how do we use this model when free cash flows are negative? A company cannot have a negative stock price or negative firm valuation. The lowest that it can be is 0. When companies are first starting, cash paid for investing activities is typically much greater than cash received from operating activities. As an example, let's take a look at Tesla's most recently reported statement of cash flows. These numbers are in thousands. So when we scroll down to look at the total cash paid out from operating activities, we see that the total net cash paid out is $60 million. From that, we want to subtract out the net cash paid out for investing activities, which is over $4 billion. So we can see that the free cash flow is a very large negative number. How can we use that to value the company if the company is expecting to have negative free cash flows for the next few years? A second problem arises from using free cash flows to measure firm value. Remember that free cash flow is equal to cash from operating activities less cash from investing activities. Cash from operating activities is typically positive only following the startup phase, and cash from investing activities is typically negative until the company is selling off its plant assets towards the end of its life. This means that cash paid to purchase land, buildings, and equipment results in a decrease in firm value. We know that firms make these long-term investments to increase firm value, not to decrease it. Also, by this logic, we could say that a company could avoid a decrease in firm value if it chose not to invest in plant, property, and equipment, and we know that that would not work in the long run. Free cash flows would do a better job measuring firm value if cash received from operations were matched with the cash investments that generated those operating inflows. What does that sound like? It sounds a little bit like accrual accounting, which is the basis for measuring net income. Accrual accounting is based on two main principles. One is the revenue recognition principle, which says that revenues are recognized when earned, or more specifically, when a performance obligation is satisfied, but regardless of when that cash is received from the customer. The second principle is the matching principle, which states that expenses are recorded in the same period as the revenues they help generate. Accruals are the difference between net income and cash flows. The only difference between net income and cash flows is the timing of when a transaction affects cash flows versus when it affects net income. Let's look at a few very basic examples. Here are some very basic examples type of material you covered in your basic introductory financial accounting class. But what we're doing is focusing on how transactions differ between how they affect net income and how they affect cash flows. So for this first transaction on January 1st, the company provides a $300 service to a customer on account. What happens? We would record this entry to accounts receivable, and we would say that this is our accrual account. Because even though it doesn't affect cash, we want to record the revenues. What happens to net income? Income goes up by $300. What happens to cash flow? Nothing. So what is our accrual? It is accounts receivable. Next transaction on January 1st, the company received $250 in cash from a customer related to services that will be provided on January 30th. So the customer is prepaying the company. So from the company's perspective, they are receiving cash of $250, but not recording revenue because they didn't provide the service. They still have a performance obligation. So we record that as unearned or deferred revenue. And remember that this is a liability account. So what happens to net income? Nothing. What happens to the cash flow? Cash flow would show cash from operating activities going up $250. That accrual account is unearned revenue. Don't forget That's a liability, unlike our accounts receivable, which of course is an asset. January 15th, the company receives a $150 utility bill for the past month, but does not make the payment. So we record the expense. So we see that income will be affected here, but we do not have a cash payment. So our accrual will be accounts payable. Net income goes down $150, but nothing happens to cash. That accrual is accounts payable. On January 30th, the company provides $200 worth of services to the customer who had paid in advance on January 1st. This customer had prepaid, and now time has passed and we are actually providing the services. So therefore, we want to record the revenue, but we're not receiving more cash from this customer. The customer prepaid. What we want to do is release that accrual, that reserve. So we decrease the liability account unearned revenue for the amount of services which we provided. So when we received the cash, there was no impact to net income. Now when we actually provide the services or perform the performance obligation, we record $200 net income, but now nothing in cash flows. That accrual is a release of the unearned revenue accounts. Unearned revenue goes down. Finally, on January 30th, the company pays $1,000 for equipment to be used in operations over the next 5 years. The company receives the asset equipment worth $1,000. They finance it by paying cash. What happens to net income? Obviously, nothing on the moment that we are purchasing the equipment. We're going to recognize the expense of purchasing the equipment, probably straight line evenly over the 5-year period. So we need some time to pass before we can record any impact to net income. What happens on cash flow? Cash goes down $1,000. So we can see from a cash flow perspective, we see cash going down $1,000, but no offsetting impact to net income. Hopefully here you can see why accrual accounting matters compared to what we looked at with the discounted cash flow model, where we're focusing only on those cash flows. So our accrual here would be the equipment account. So my net impact on net income goes up by $350 for this month of January. What happens to cash flow? Cash flows actually went down by $750. We see a very different picture being painted depending on whether we're looking at net income or cash flow. Next, let's look at a really basic example taken from the back of Chapter 4. This is E4-14. Microsoft reported $62.484 billion in revenues in the year 2010. Accounts receivable increased from $11.192 billion in 2009 to $13.014 billion. Microsoft has been criticized for underreporting revenue. Revenue from the software licensed to computer manufacturers is not recognized until the manufacturer sells those computers. Other revenues are recognized over the contract periods with customers. As a result, Microsoft reported a liability, unearned revenue, of $14.83 billion in 2010, which is up from $14.284 billion in 2009. The question is, what was cash generated from revenues? So we are given the revenue on an accrual basis. We're given changes in 2 accrual accounts. One is accounts receivable, the other is unearned revenue. And we want to see what would cash be from revenues or cash from customers. Okay, so to get down to the cash from revenues, we start with our $62.484 from revenue recorded on an accrual basis. And then we look for the adjustment. We had an increase in accounts receivable. We may have had one too many C's here. All right, so what happened to accounts receivable? Accounts receivable went from 11.192 to 13.014. So this difference here is an increase in accounts receivable. So what do? Are we going to add that to the revenue or subtract it? Well, we're trying to get down to cash from revenues, and we're starting with revenue on an accrual basis. So what happened when this difference here is 1.822 billion, And what happened? When we recorded this increase in accounts receivable of 1.822, the company recorded revenues that did not affect cash. So we want to subtract out this increase in accounts receivable. So this 1.822 was included in this revenue and accrual basis, but shouldn't be when we get to cash from revenues. We also have an increase in unearned revenue. And we have to think about whether we're going to need to add that or subtract that. So unearned revenue went from 14,284. Oops, let me start with a bigger number here. Went from 14,284 to 14,830. And this difference is 0.546. So let's think about what this is. The company recorded unearned revenue. That unearned revenue did not impact revenue, but it is cash from customers. So this 0.546 was not included in the revenues, but should be included in cash from revenues. So therefore, we're going to add 6. Obviously, if there was a decrease in unearned revenue, we would subtract it. And if there was a decrease in accounts receivable, we would add that. And when we look at our adjustments now, we should come back to 61.208. That is how much cash we received from revenues. So we talked about the benefits of looking at accruals and how to adjust cash accounting to get to accrual accounting. But we have to discuss a few of the issues involved in accrual accounting. It is not perfect either. First issue, accrual accounting allows choice in measurement, such as inventory cost flow methods, LIFO, FIFO, or weighted average, depreciation methods, straight lines, declining balance, activity method. Another issue is that accruals involve judgment. Think about when the manager is trying to determine an estimated useful life on equipment or building. They have to use some discretion there, or if the manager is trying to estimate bad debts expense. Clearly, management can use this judgment to influence earnings upwards or downwards, whatever that manager is looking to do for that specific period. And 3, costs incurred for future benefits, they aren't always reported as an asset on the balance sheet, even under accrual accounting. One example of this is investments in R&D. R&D are typically, and for most part, expensed immediately. Why is that? Well, FASB says that it's so difficult to determine when the actual cash inflows are going to come from the R&D expenditures. It's hard to match those, so we just expense them immediately. However, this could be considered an accrual if GAAP were to allow that, because it's an investment with the intention of generating future cash flows from customers. So are earnings a better measure of firm value than cash flows? Well, analysts forecast earnings, not cash flows, and the stock market appears to value firms based on their expected earnings. When we meet on Saturday, May 5th, we'll discuss the concept of residual earnings, and we'll learn how to calculate the value of equities from forecasts of earnings and book value. This corresponds to Chapter 5 of the textbook. As soon as you finish this video, what I'd like you to do is work on their two practice questions. Very short, should only take you a few minutes. The solutions are at the end of the document, and these are posted in the class materials section for this week, week 4.